Good morning, everyone. We did promise to start at 11:05. We are seeing that there's still some few people that are coming in on the call, but I think for the sake of time, and we do have quite a jam-packed agenda, so maybe let's continue with this conversation, and then as the rest of the attendees join in, I think that will be fine. Then we can continue with the discussion. My name is Ashan Chobodwana. I'm the head of public sector for transactional banking. I've been with the sector for my entire career at Standard Bank, so I consider myself a public servant at this point in time, given that I've worked with so many of you in the sector. I think for us as Standard Bank, it was quite important that we preserve this session with yourselves, as we truly take public sector as one of the most strategic sectors for Standard Bank, and having an in-depth knowledge in the sector and understanding of the regulatory requirements in the sector has forced us to always go back to see what are some of the best solutions that we can always bring to the sector. And this is why we're having this session today. But let me just maybe start with the house rules. The session is going to be for about an hour and a half for today. We will allow you to have a Q&A later on in the session, but please, if you do have any questions or comments as the speakers go along, do put them in the chat box. We will make sure that later on we do read them out to them to respond to that. You'll also be allowed to raise your hand on Teams, and you can unmute yourself and ask the questions. But as the speakers continue to speak, please do put yourself on mute. We're just avoiding any disturbances and any maybe lunga thinking that somebody wants to say something at that point in time. So please, if you can stay on mute, we will let you know and call you out when you want to ask the question and unmute yourself. And again, maybe I need to apologize that the last time we were supposed to have this session, we had no choice but to cancel it at the last minute because of technical issues. We have done every testing we could do this time around to make sure that we don't have any such disruptions. Hopefully, we should have a smooth sailing session. I think let me maybe start by just briefly giving you a background on Standard Bank. I mean, most of you are all South Africans, you would know Standard Bank, but I thought it's important that I articulate that our purpose and value and aim for Standard Bank really is to deliver sustainable growth for the individuals we deal with, the businesses we deal with, but including the communities that we deal with as well throughout Africa. And as our slogan also says it, Africa is our home, and we drive her growth. And truly speaking, that's exactly what we are about. And that's why public sector for us is quite critical, because we understand the mandate that the public sector delivers to South African communities. We are an entity that's over 160 years old across, and we do cover across so many countries in the continent. We are in over 20 countries. We have over 15 million active clients in the book, and we manage 1.4 trillion assets globally as Standard Bank. I also wanted to touch a little bit on our relationship with public sector. We partner government across all spheres of government, which is national, provincial, and local. We also bank the constitutional institutions of government, including also Schedule 2 entities of PFMA, as well as Schedule 3 entities of PFMA. We also have a very strong relationship with National Treasury, as well as we do support the national governments. And for me, the reason why I had to highlight this is just, again, to showcase that we do have quite a deep and intimate understanding of the sector, including all the regulatory requirements that are actually applicable to the sector. And so we are one of the banks that are well positioned to be able to always bring to you guys, whether it's financial or non-financial solutions, given the mandate and the relationship that we have with the sector. Let me then maybe move to today's discussion and what this is about. And I think, as I've already said, public sector for us is very strategically important for Standard Bank. And we understand the mandate that public sector has to deliver, and we do support it. We buy in on it fully. And over and above that, I think we do understand the significant demand for the infrastructure, energy, transport, and the service delivery that is driven by this sector, and the need for us to start looking at sophisticated and targeted financial solutions for the sector in order to realize the goals that the sector is trying to achieve. And given this strategic importance and this understanding, this is why we're always looking to see what are some of the best solutions that we can bring to the sector, being cognizant of some of the challenges and the trends that the sector is facing. Today, we are going to be speaking to you guys about an off-balance sheet solution that we feel strongly that it needs to be penetrated into the sector, given what we've seen on the market when it comes to access to funding, high cost of funding, some of the government entities not even being able to have the mandate to be able to borrow. And those that can borrow actually will have to go through quite a long and stringent process of national government for those approvals. So we're trying to move away from that to say, what are some of the things that we can bring to you guys, as we see that as much as there's all these challenges, your suppliers or your service providers are not stopping from asking you to still give them some sort of a form of security or some form of guarantees. And the fact that now we are very, I guess, it's tight for us to be able, always be able to do the funding solutions, the guarantees, and the letters of credit. What are other mechanisms that we can do to still continue to support you? And that's what today's session is about. So we've got a team of expertise in the room that are going to be taking you through the solution that we just wanted to bring to your attention. Again, we will be recording the session. We will be sharing the presentation with yourselves so that you can also look at it at your own time and always come back to us if you want us to explore on a bilateral basis on the solution. We're more than happy to do that. For today, it's just an exchange of knowledge and our experience of some of the government entities where the solution has also been implemented on. But let me not take too much time and take the thunder away from our executive head of credit, Boboza Mashini, who's going to be actually speaking to you guys just around some of the trends, some of the things that they've seen as they're dealing with the sector and that they just wanted to bring to your attention. So I'm going to hand over to Boboza. He is our executive in credit risk, specifically focusing on public sector, which is the focus of today's conversation. Bob, over to you.
Thanks, Asia, and a very good morning to everyone, including all our stakeholders. So yeah, when I was asked to do an overview, a presentation as to what is it that we see out there in the market, and what the trends are, it was a bit of a challenge and complicated because there's just so much, there's so many moving parts, especially when we start talking public sector, which is directly linked to government, is directly linked to sovereign, is directly linked to the country. But just at a very high level, maybe just to share how the public sector team looks at solutioning. We do cover all three spheres of government, including the relevant departments and agencies that are linked to those particular departments who carry a particular mandate to execute. We also cover some state-owned entities. And then we also extend our assistance to some of the divisions within the bank who are looking after clients who rely on some of the state-owned entities or rely on the government departments or agencies for support to get them over the line on their side. So at a government level, I won't just talk about or look at only South Africa in isolation, because it's important that when we look at our country that we also compare to what we see in the continent as well. So what we have seen, for an example, is that there's pressure within the fiscal space across the continent, but I think we are a little bit better compared to some of our brothers in the continent. What we are seeing out there, for an example, is the pressure around liquidity, high inflation, high interest rates, and that puts pressure on the country's balance sheets, which then affects, state-owned entities, departments, and so on, as to how they can raise debt. The tax collection slippages, we've seen them across. Runaway debt profiles, we've seen them right across. So these are very important considerations because, by and large, when state-owned agencies or state-owned entities, when they do need to raise finance of some sort or need to survive to pay salaries and all of that, the tax collection bill is very, very important. So when there's slippage, we do look at those slippages to say, what does that mean for this entity? How can we provide some support? So at a national government, we do provide some solutions on the balance sheet side. In terms of we extend bonds, we extend loans and working capital facilities covering different tenors. And we also provide some assistance in terms of payment solutions. But what we have seen also is that the role that is played by provinces. In our space, what we've seen in terms of provinces, there isn't much borrowing that is happening there, but we do support them in terms of payment solutions because provinces are generally restricted in terms of borrowing. They'll need a minister to support in terms of the borrowing. But in terms of bridging facilities, we have been able to assist those provinces because the way they are generally structured, about 90 or 95% of whatever is coming, it's allocated from the fiscus by the Minister of Finance, and very small amount is generated within provinces that could take a form of taxes for gambling or licensing and all of that. And whatever surplus is sitting there is generally surrendered back to the national or provincial revenue fund, because the intention is not to build balance sheet there. But where we do assist is, for instance, the payment of salaries and suppliers and all of that, mainly covering healthcare workers, police, and so on. I think the interesting one is, for an example, the last sphere of government, which is the municipalities. What we are seeing there is balance sheets that are quite tight. And then as we've come out of COVID, municipalities that were struggling, they struggled even more around collection. People have lost their jobs. We've seen, lack of infrastructure investment over a period of time, whether it's around electricity or water, that as that infrastructure comes under a lot of pressure, we're seeing a lot of water losses, mainly what is generally called non-revenue water. I think the stats are very scary. And then when they do sell water, the collection around water is also a concern. And then electricity, as we've seen challenges around load shedding, and as well as expansion of services. So with that, that's put municipalities under a lot of pressure, as far as the liquidity is concerned. The ratios that have been set by the National Treasury for most of our municipalities are not tracking in line, and that complicates matters. We've seen some arrears building in different municipalities, whether it's to the water boards or to the Escom, or sometimes to other suppliers as well. So those are some of the observations that we've seen in the municipalities, and other issues as well as they may have been pronounced in the public space, governance issues. We've seen the coalition structures that sometimes are not holding. That sometimes put pressure to the teams, the finance teams, because then they need the support of the council to be able to approve budgets and so on and so on. So that has added some pressure. So some of the developments we've seen, for an example, the Minister of Electricity has said that he'd like to see, revenue in as far as electricity is concerned being ring-fenced so that there's investment in that infrastructure. The Minister of Water and Sanitation has made similar comments. I think he's also looking at amending the bill, which will ensure that municipalities ring-fence water revenue so that whatever is allocated for infrastructure goes to infrastructure, so that we don't start seeing the problems that we are seeing, where not only leakages, but that the infrastructure is aging and that there's no investment. In the state-owned entities, I think that's also a little bit more pronounced. We've seen pressure in different balance sheets of the state-owned entities. That creates an issue in around the supporting entities, to invest in revenue, to invest in infrastructure and service clients. So the state has come to support the entities in various ways, whether it's by way of guarantees or allocations from the fiscus. We've seen some of that pressure. And then in the past, we've seen also governance issues there in the state-owned entities. I think also that one publicly has been pronounced. So what we do sometimes try and assist, because if you can't assist government, you become irrelevant. So we have means and ways to assist state-owned entities or agencies by ensuring that the risk that we do take, if we cannot get it collateralized, we can sell it off. If we can't sell it off, we can buy some form of insurance. But the most important thing is how do we then solution. So if, for an example, is regarding payment solutions, I think I'm not going to talk about the solution that's going to be presented here, which doesn't create a credit risk. It's off balance sheet. I think it's one of the solutions that we look towards providing. But in as far as lending is concerned, where we can come to an agreement with the state in supporting those entities, we generally have been able to get some guarantees, or that we sell off some of that debt, or we buy insurance. And we have come with some of the most innovative ways in ensuring that the position is such that we are able to raise debt, assist those entities in raising debt, fund their mandate, but also that we manage our risk accordingly. There's just too much to cover, so I thought that let me just nip it there. It's very broad, it's not very specific, and it's by design and intention, because I think it's just to give an overview as to what are the observations that we've seen and observed, in the public space. Thanks.
Good morning, everyone. So my name is Nobulo Matsabete. Thank you so much, Boboza and Asia, for positioning and just also highlighting the partnership that we as Standard Bank have had with the state-owned entity over the years. And I think just based on what you said, Boboza, around our credit view, it actually shows that not only do we actually put our funding solutions forward to our clients, but we also try and partner with them to find other alternative means of providing them with the support as they navigate the South African economy. And this also ties in extremely well with the solution that we're presenting today. So we are obviously aware of the fact that our clients are generally confronted with the requirement of providing some sort of certainty or comfort to their counterparties to confirm that they'll be able to meet their payment obligations under the underlying contractual arrangement. It's safe to say this is not a requirement that is unique to public sector clients, but it cuts across all of our clients. And we as Standard Bank have come up with a solution outside of our traditional funding solution or traditional risk mitigating instrument to be able to assist you in responding to this ask. And this then brings me to discussing what an escrow account solution is. Well, an escrow account solution, it is a tripartite arrangement between Standard Bank as an escrow agent, a state-owned entity, and a relevant counterparty. And the counterparty could be a service provider, a supplier, or a seller, whatever the case may be, where the state-owned entity and the relevant counterparty, they agree to house funds in an escrow account that is held with Standard Bank as an escrow agent for funds out of that account to be released as and when certain agreed terms and conditions are actually met. It is important to highlight at an outset that the funds that are sitting in the escrow account are not a Standard Bank fund, meaning that there is no credit intervention from a Standard Bank perspective to advance the funds. So these are the funds that generally belong to a state-owned entity. And because of this, then you get to then keep your funding and your contingent liability position safe, irrespective of the solution actually being put in place. And that's the off-balance sheet treatment that Asia was referring to. And then the second one is that the agreed terms and conditions are not stipulated or dictated to by Standard Bank. It will be the terms and conditions that you as a state-owned entity and the relevant counterparty have agreed. And we then, as Standard Bank, would act upon you confirming that those agreed release and return conditions have been met. Now, there are two main benefits of an escrow agreement. And the one is that it acts as a risk mitigating instrument in the sense that it provides your counterparty with certainty that there is money that is ring-fenced, set aside for a particular purpose. And once they're performed under the underlying commercial agreement, they would sign a joint instruction confirming that those terms are met and therefore the funds need to be released. So it gives them control in terms of when the funds are going to flow out of that account. But equally, for you as a state-owned entity, you also have an added advantage of making sure that the funds out of that account will flow once you've confirmed that the counterparty has performed in substance, in quality, or in quantity in a manner as agreed to under the underlying arrangement. The second one, and I think the second one is quite important, is just around how cost-effective the solution is. I had alluded to the fact that the funds that are sitting in the escrow account are not a Standard Bank funds, they're your own funds, so there's no lending and interest cost that is associated with the solution, which means then, from a Standard Bank perspective, there's no credit intervention, which would be a credit intervention required should you want Standard Bank to issue an LC or a guarantee. Now, at this point, I want to highlight that this solution is not a new solution. It was put in place in 2009, way before my time. And where we've seen it working very effectively is in mergers and acquisition transactions, sale of properties, and service level agreements, and service level agreements of any kind. This could be a property development, construction, or any other commercial arrangement. What this actually tells you is that this solution can be tailored to any kind of a commercial arrangement that you have. It's a plug and play, but also it speaks to your own requirements. Now, the key features of the escrow solution is that we as Standard Bank are appointed by you to act as an escrow agent. We facilitate the escrow arrangement through an escrow account. This escrow account is held and controlled by Standard Bank. But what is important is that it's not the same account as your current account or investment account where you'll be required to sign the account opening documents. It is 100% Standard Bank controlled account, and we actually manage that process of opening the account internally. However, the benefits that you would get is that you get visibility in terms of the balances that are standing to the creditor of that account. We provide you with monthly statements or any interim statements that you would want, evidencing the flows that have gone out of that, out of that account. And then the last one is that the escrow account, whilst it's not akin to a current account or an investment account, it is an interest-bearing account where the interest that accrues on that account for the duration or the tenure of the escrow agreement is actually accruing to the benefit either of the state-owned entity or the third party as agreed to between the relevant counterparties. On the next slide, okay. Sorry, my screen just froze. Okay. Apologies for that. Okay, on the next slide, I'm just going to be taking you through the transaction flow. And the actual purpose of me highlighting this is just to show you how seamless this solution can integrate with your own commercial arrangement. So as you would ordinarily do today, you would enter into a commercial arrangement with your relevant counterparty, but instead of now agreeing to the counterparty requesting you to provide a letter of credit or a guarantee, you would then position the escrow solution to your counterparty. And we are always happy to jump on a call or meet with your counterparty to position how the solution can provide them with the necessary security that they need around the payment, your payment obligations. So once you've concluded your commercial arrangement or simultaneously with your negotiation of your commercial arrangement, we will then share with you our escrow agreement. We have a designated legal team that will partner with you in terms of negotiating the escrow agreement. And simultaneously, as we're negotiating, I, as your trade sales manager, would undertake to then open the escrow account for you. Once that escrow account has been opened and the legal agreements have been signed, I would then share the account in terms of which you would then, as a state-owned entity, would have to fund that account, right? Again, as I had alluded to earlier, we would then confirm once the funds are sitting in the account. And should you require a statement from a reporting perspective, we do provide that statement. Now, once the account is opened, the escrow agreement is signed, and now the transactions are actually flowing, your relevant counterparty is performing in respect of the underlying arrangement, you and the relevant counterparty, you will then have to agree when the terms and conditions or the agreed release conditions are actually met. Once you've agreed that, you would sign what we call a joint instruction. A joint instruction, it's a one-page template that we will provide to you. You would then sign it and confirm that you are happy with those agreed terms having been met, and you would then share that with Standard Bank. Once we've received the joint instruction, we would do our due diligence processes in checking that it's signed by the relevant parties, etc. And that's just an ordinary thing that we do even when we receive our utilization request. And then once we've done that, then we will then pay it into a designated account. So again, it plugs in very seamlessly with your underlying commercial arrangement, and it gives you that added benefits and added control in terms of knowing that you will be the one to instruct Standard Bank to release the funds as and when you're satisfied with the underlying terms and conditions being met. Now, on the slides, we just wanted to highlight some of the information that we require in order for us to see how we can partner with you in putting the escrow arrangement together. But as you would see, as I'm discussing these points, these are not points that are unique to an escrow arrangement. These are certain, commercial questions that we would ask in order to make sure that we fully acquainted with the underlying commercial arrangement, and therefore we can partner seamlessly. So the first one, if you look at your far right, would be your transaction background. Again, we want to know, is it a merger and acquisition transaction? Is it a sale of property? Is it a service level agreement? We would also want to know the relevant parties that are involved. Is there a foreign entity that is involved? Because obviously that triggers some of the the legal implications for that. And we want to understand which entity would be, a state-owned entity would be countersigning the escrow arrangement. We also do want to find out about the currency. If it's local currency, as you would know, there won't be any ex-con implications. But if it's foreign currency, we would then have to see how we can advise you in getting that approval going. And then we also ask you around the value of the value that's going to be sitting in the escrow account. And the reason for that is that the escrow account is not meant to be a transactional account. We generally see it housing huge amounts of money for a designated purpose, being a project, as I said, or a sale, and then the funds are then released once those conditions are met. And this brings me to also why we tend to ask questions around the number of transactions that are going to flow out of that account. We generally prefer for it not to be a very transactional account. Again, because if you want a more transactional account, you can set that aside using your own current account. But this one is just designed to for funds to be released upon certain conditions being met. We also do ask you questions around the tenor. How long are we supposed to keep the funds in the account for? Even though our actual legal agreements are for evergreen, it just gives us some more information from a business perspective in understanding the escrow and the commercial arrangement. KYC, I'm sure you're well acquainted of that. We do ask some KYC related information, but if you are a Standard Bank client who is KYC compliant, we do waive that requirement. And I had already spoken about the ex-con or exchange control approval that might be required depending on the currency of the transaction. On the next slide, we just tried to sum up and give you a picture view of how we actually implement the escrow arrangement. If you look at the top left, we looked at the key escrow account documents. And again, these are the documents that you're quite familiar with regards to KYC, but we will be sharing our escrow account agreement. It's a very light document. It's not a 300-page long document. It's very light. And as I've alluded to earlier, the release and the return conditions are dictated to by you. So it is as in terms of your underlying commercial arrangement. And then before I get to the fee structure, I also just wanted to take you through the execution step. But in most cases, or in most instances than not, all of these steps are actually run simultaneously. And we are able to implement this process within a week, depending on the negotiations, of course, around the actual escrow arrangement. So at pre-transaction stage, again, we're confirming the transaction using the details that I've already spoken to. We confirm KYC, legal agreements are shared. I'm then responsible for opening the account. Once the account is opened, documents are signed, then the amount would deposited into the escrow account, and then the ongoing disbursements would then happen as in the ordinary course. We also guarantee you a lot of support around putting this in place. We have a legal team designated to respond to any of your legal questions that you might have. Again, this is quite instrumental when you're positioning the solution with the counterparty who's not too familiar with the arrangement. We partner with our legal team. I will be on the call facilitating. We make sure that they're very comfortable in terms of the legal benefit that they get from putting this solution in place. And from a KYC perspective, I will also be in charge in terms of, asking you for the relevant documents in respect of the third party, etc. And also, as your dedicated sales resource, just coordinating, making sure that everything is done and it also meets your expectations. And then again, if there is a foreign currency implication or a foreign entity that is involved, we then just deal with the relevant ExCon requirements. Now, from a fee structure perspective, as I've said, there are no funds that are being advanced by Standard Bank, so we don't charge you any negative interest. Instead, we provide you a credit interest on your account, meaning that for the duration of the escrow arrangement, you will be getting a credit interest. And again, this is dependent again on the structure of your escrow arrangement. Is it a very transaction heavy escrow arrangement? What is the quantum? What is the tenor, etc.? But we will disclose this to you during the negotiation process. And then we have a very minimal monthly management fee, also negotiable. We will disclose this to you, and then you would just let us know. And then we have a once-off structuring fee. Again, this in comparison to the fees that are generally charged by law firms for putting a similar arrangement is like really close to nothing. But again, it's negotiable. We partner with you in order to make sure that you're quite happy with the fee structure. So at this point, I'm going to hand over to our senior legal advisor, BK, who's just going to take you through some of the legal nuances that comes with implementing an escrow arrangement. BK, over to you.
Thanks, Lunga. Afternoon, honorable guests, ladies and gentlemen. My name is BK Tawana, and my job today is just to give you a legal walkthrough of escrow agreements. At its core, an escrow agreement is and should be simple. As much as the supply contract it supports is often complex, as long as the parties have a full appreciation of their roles, the escrow agreement ought to still be simple whilst remaining fit for purpose. As Lunga intimated earlier, there are at least 3 parties to an escrow agreement, the SOE, the supplier, and the escrow agent being the bank. The SOE is the buyer and the supplier the seller in terms of the supply contract. Throughout this discussion, I'll use the term supply contract, which simply means the underlying contract between the buyer and the seller. My use of this term isn't meant to be restrictive, because the escrow solution works for any underlying agreement that involves a payment obligation, regardless of whether that underlying agreement is called a supply contract, a purchase order, a service agreement, or any other name. I'll now turn to some of the key considerations of escrow agreements. And a number of these elements appear in the slide before you, but I will only focus on the 4, which I feel are the most important ones. And you'll notice that in any event, 3 of these 4 elements in some way draw together and interact with every other element, even though I don't discuss those other elements individually. The first element, independence, is by far the most fundamental one. The escrow agreement exists because at supply contract level, the SOE and the supplier have agreed on escrow as the most appropriate payment vehicle. However, it's important to bear in mind that although the escrow agreement owes its existence to the supply contract, it is not a part of the supply contract or even an extension of the supply contract. The escrow agreement stands on its own and represents a completely different legal relationship. And when you look at an escrow agreement, the only reason it even mentions the supply contract is just for context and ease of reference. The second element is the passive nature of an escrow. The bank plays a passive role, meaning that the bank is not a party to the supply contract. The bank simply assumes the duty to facilitate payments, but that duty is owed under the escrow agreement and not under the supply contract. As you can see, the beauty of an escrow agreement is that it enables the bank to help in the implementation of the supply contract without itself becoming a party to it. And just as the escrow agreement is independent from the supply contract, the bank is likewise independent from the supply contract. The third element is reliance on instructions. As I've said, the bank's primary duty under an escrow agreement is to make payments. This being the case, what then are the payment triggers? Under our standard escrow agreement, the chief payment trigger is the bank's receipt of a joint instruction signed by the SOE and the supplier. That joint instruction will tell us one of two things. Either A, pay the supplier because they have fulfilled the terms of the supply contract, or B, refund the SOE because, for example, the supply contract has been cancelled. When determining whether or not to make a payment and who to pay, the bank must be entitled to rely on nothing but the joint instruction. The prescribed wording and format of the joint instruction is agreed upfront as is in fact a schedule to the escrow agreement. And the value of this is that it minimizes disputes as to whether a particular instrument validly constituted a joint instruction. So the bank's entitlement to rely on the joint instruction and nothing else flows directly from the independence principle I spoke of earlier. In the context of a joint instruction, the independence principle means that the bank must not be required to do calculations, authenticate certificates and invoices, verify the completion of milestones, or investigate any other matter in connection with the supply contract. Put another way, the bank must be entitled to take the joint instruction at face value and take it for granted that because the SOE and the supplier have issued a joint instruction, this automatically means that they are aligned at supply contract level, that a payment trigger has happened. The next element is capacity and authority. When concluding an escrow agreement, a fundamental consideration is whether the SOE has the requisite capacity and authority, and I'll discuss these two elements separately. When it comes to capacity, this is a question of whether the SOE is permitted to enter into escrow agreements in the first place, and a question of whether any procedural steps must be followed or any approvals must be obtained. It involves a comprehensive review, and we would look at such things as the PFMA, any specific legislation that established the SOE, and that SOE's constitutional documents by whatever name. We would then ensure that none of these documents taken together prohibit escrow agreements. Then when it comes to authority, this is about satisfying ourselves that the specific individuals who sign the escrow agreement have permission to sign the contracts on behalf of the SOE, and in so doing, bind the SOE. So this permission can be recorded in a board resolution or a delegation of authority, for example. And as Standard Bank, we appreciate that SOEs are highly regulated entities. And as the bank, we have to collaborate very closely with and rely on our SOE clients when considering their capacity and authority. That said, you'll be glad to know that escrow agreements have two features that provide enormous regulatory relief. My colleague Lunga has touched on them, but they are important enough to repeat. The first one is that an escrow agreement does not amount to borrowing in the PFMA sense. And B, implementing the escrow agreement does not require an SOE to open a new bank account. The escrow account will be an account created by and belonging to the bank, albeit carrying the SOE's name for allocation purposes and no other reason. And then I turn to another emotive topic, which is that of insolvency. In several of our informal conversations leading up to this presentation, we've often been asked about insolvency and its impact on the escrow agreement, more especially its impact on the money sitting in the escrow account. If I may, I'd like to highlight a number of things which I hope will allay a lot of your concerns about insolvency. First, when it comes to escrow monies, an escrow agreement properly interpreted separates ownership and control. On one hand, the bank necessarily takes control of the escrow account and the money sitting in it, because this control is central to the bank's ability to perform its duties as the escrow agent. On the other hand, at no point during the life of an escrow agreement does the bank become the owner of the escrow money. Ownership only passes from the SOE to the supplier when there's a payment trigger as defined. Ownership never passes from the SOE to the bank. The other thing which I hope will allay your concern is that outside of a joint instruction, the only other ways in which a bank can validly make payments under the escrow agreement is arbitration awards or court orders. We could, of course, also be compelled by directives from liquidators or business rescue practitioners, but these directives are typically converted into court orders in any event. And lastly, there is true power in the joint instruction. If the SOE ever becomes concerned about any party's insolvency, it can simply withhold its co-signature of the joint instruction. Without the SOE's co-signature, there is no joint instruction. And without a joint instruction, there is no payment, except in very limited cases. So this is my long way of assuring you that the bank never deals with escrow monies arbitrarily. It is always strictly guided by some sort of instruction. In the ordinary course, that instruction will be a joint instruction, which is contractual in nature. The instruction becomes non-contractual if it comes from a more compelling authority, such as a court or a regulatory body. So, ladies and gentlemen, this brings me to the end of my presentation. Escrow agreements are absolutely fascinating devices, and I hope my passion for them has rubbed off on you a little bit. Furthermore, I trust that my discussion of the key aspects will enable you to engage meaningfully with the topic the next time you encounter it. But above all, we look forward to sitting next to you around the table as we negotiate many fruitful escrow agreements together with your various suppliers. Thank you very much.
Thank you so much, BK. I think we have seen that passion as you were doing your presentation. Thank you so much, BK. Thank you so much, Nokulunga, as well on the product side, as well as Boboza on the credit aspect as well, what we've seen in the market. We'll pause it here in terms of the presentations and maybe just see if there's any questions, comments around the structure. I have put my details on the screen as well if you still want to ponder on everything that has been shared with yourselves, where you can also email me and be more than happy to share to answer any questions also on email. Dumisani, we have noted your ask. We are going to circulate the presentation to all the attendees as well as the recording of this session as well, post the session. So you will be receiving the presentation. But let me just see if there's any questions from the broader forum. You can raise your hand. Wait, Babota, I see your hand. Please go ahead, ma'am.
Thank you, Asha, and thank you to the Standard Bank team for such a thorough presentation. But I would like to go back to, I think it's Nokulunga. I'm, sitting here Nokulunga, the outflow of cash at the beginning, for me, it doesn't sit as a benefit for an escrow account. For me, I think I would still revert back to either an LEC or a guarantee. So I'm still not convinced. I think, yeah, from maybe where we are sitting as Eskom in terms of cash flow, we would rather still convince, our suppliers or clients to either go through the LC or guarantee route. I don't see many benefits for escrow. Maybe I missed it. If maybe there's more that you think can be beneficial. Thank you.
Now, thank you so much for that question. I think the key benefit for an escrow solution is that there is no credit intervention, which means that you don't have to come to the bank and request for the bank to issue a guarantee. Because remember, when we issue a guarantee, we have to allocate facility for you, and there's actually a charge that we charge for that service. So I think it's charged quarterly in advance. So if you are a state-owned entity that is experiencing some sort of difficulty in getting funding lines, your escrow arrangement then works seamlessly in that instant. And also, even when you're trying just to manage some of the interest payment and the cost of funding within your organization, and make sure that you have a solution that falls outside of your normal balance sheet. So, because you won't be recording this as a debt, it's your own money that is sitting in the escrow account. And the second one is that you still provide your relevant counterparty with security that they will be paid once the underlying contractual arrangement or obligations of your suppliers have been met. It differs very significantly from your normal risk mitigation solutions like your guarantees in that sense, because they are in control of when the funds are going to flow out of that account. I'm not sure if Musa, you would just want to jump in as well.
Yeah, and I think there's two additional aspects that we also need to consider. One, obviously, in terms of a bank guarantee, considering that it is a contingent instrument, yet again, if you want to manage in terms of your balance sheet, contingent instruments that are in your balance sheet, this particular solution can reduce that contingent instrument value in your balance sheet. The other piece, Longa did mention around the cost of the actual instrument. So even on bank guarantees, even if it is, for example, cash covered, we will hold the cash cover, but the outgoing instrument will still charge a particular fee. And then I think the other third component around, especially a guarantee that you issue out to a counterparty, is that it is a demand instrument. So ultimately what we've seen, especially in the market, especially in cases of a dispute around performance, etc., effectively the beneficiary of that guarantee, because it's a demand instrument, they can simply lay a claim under that guarantee, and you effectively have no recourse in terms of stopping that particular claim. So as a bank and under effectively URDG, which governs guarantees, we are obligated to pay under that particular guarantee without actually having an ability to effectively stop that process. But under an escrow account, because of the joint instruction mechanism, you have to satisfy yourself that effectively that particular entity has performed, and therefore you need to sign off that release of cash. So those are some of the elements to consider as well when comparing the two instruments.
Are you answered?
Hi.
Yes, thank you very much, Asya. Thank you.
Great. Dumisani, let me come to you. Dumisani, you can unmute now.
I think maybe we can take Benjamin's question.
Okay, I think while we're waiting for Dumisani, let's start with Muzi. Muzi, you've got your hand up.
Yeah, thanks, Asya, and good morning, everyone. My name is Muzi. I'm also part of the Standard Bank team. I just wanted to add to the response the team has given to Mapotla with regards to the benefit of an escrow. So what we tend to also experience with a few government entities or parastatals, etc. In some instances, you establish special purpose vehicles to work on projects. And those SPVs, most times, they don't have a track record of managing finances, but they have the right to contract with service providers. And those service providers, in most instances, feel uncertain on whether they will receive payment, and they want comfort that there is some form of a confirmation that they will receive payment post completion of the contract that they've been given. While that new SPV may not necessarily have the right to borrow, it may be funded, and it's also maybe not trusting of the service provider to do a prepayment to that service provider. This is where an escrow becomes quite essential, that we open this account that provides comfort to the service provider. It also protects the funds of the SPV or the special purpose vehicle that is issuing that contract or that piece of work. So that's where these types of structures become quite important as well. Thank you.
Thank you so much, Muzi. I see we've got two questions on the line. It's fine. Dumisani will ask your question. I think you're battling with the unmute.
Yeah.
Musa will take both questions. The first question, Musa, from Dumisani is the timelines around in terms of payment of a claim on a guarantee and also validating the guarantee itself. Benjamin is asking, do you pay interest on the escrow account?
Sure. Thanks, Asia. Maybe I'll start with Dumisani's question around the timeline. So under the global guidance in terms of guarantees, which is uniform rules for guarantees, URDG, the bank effectively has to pay out under a guarantee within 5 days of a compliant presentation. Now, effectively, a compliant presentation is effectively covered in the issuance of the guarantee. So effectively the terms and conditions of that guarantee. But usually it's effectively us checking in terms of, have the terms of the guarantee been adhered to, i.e., for example, it might state that a compliant claim requires the presentation of the original guarantee to the bank. So effectively, we will then only just check that to see if that claim is compliant. If it is compliant, within URDG, we effectively have to pay out within 5 days. As a courtesy call, though, we do notify the applicant under the guarantee that there has been a claim lodged under that guarantee. However, as I've mentioned, we cannot effectively stop that claim if it is compliant, and we need to pay within those 5 particular days. I hope that I've been able to answer your question on that, Dumisani. And then, Benjamin, in terms of the payment of interest on the escrow accounts, yes, we do effectively levy credit interest on the specific escrow account, and it will be dependent on effectively the tenor of the funds, but also in terms of the terms and conditions under the escrow agreement in terms of where that credit interest and who that credit interest goes to. On certain instances, we've seen that the majority of escrow accounts, that interest is going to be effectively accrued for the benefit of the depositor of that those funds in that escrow agreement, so i.e. the buyer. But in other instances, especially in mergers and acquisition transactions, we've seen effectively that interest being split between the two parties, or sometimes we've seen the interest effectively accruing to the benefit of the seller in those instances.
Thanks, Musa. BK, I note your hand.
I'm sorry, I just wanted to build briefly on a recurring theme in the questions, which has been the difference between bank guarantees and escrows. Now, it may be the case that escrows and bank guarantees are functionally and substantively similar, but the crucial difference between the two is that with a bank guarantee, it's a default instrument, meaning that payment is predicated on a breach. So the bank pays if something goes wrong at underlying contract level. Whereas with an escrow, payment happens when things go well and you hope they go well. So they're covering two very different things. And that's why we say about escrows that they basically facilitate the payment obligations that will happen in the ordinary course, not payment obligations that will happen if there's a breach. Thanks.
Thank you so much, BK. That is very clear, and I think you've just closed out what Mapopa's question was asking. Dumisani has come back with another question of, can you also respond on the validation of the guarantees and delays in communication after submission of a claim? So I guess the first question was, how long does it take to pay when there's a claim and a guarantee, but how are you validating the guarantee itself? Dumisani, is there no way you can unmute yourself and just give more information on your question? Let us try and see if we can't unmute you. IT, is there anything you can help us with to unmute Dumisani?
So maybe Tumsani, I'll kind of cover the process in terms of the guarantee claim. So typically, if a beneficiary, which is the beneficiary of the guarantee that has been issued in their favor, they effectively can claim under that guarantee, and the claims process is effectively covered under the guarantee itself. So typically, the primary process is for that particular beneficiary to come to the bank and effectively say that they are lodging a claim under that particular guarantee. That's the first piece. Under the guarantee, it will stipulate in terms of what is the procedure in order for that claim to be seen as compliant by the bank. And yet again, in most of our guarantees, not all of them, the key question, or sorry, the key item is the returning of the original guarantee, not the copy of the guarantee, because the original guarantee will be held by the beneficiary. So when they effectively then bring in the original guarantee to the bank and lodge a formal effective claim under that guarantee, our teams in operations and our operations legal will review the original guarantee versus the actual claim that the client has provided to us. They will then effectively see if that claim is compliant, i.e. is the original guarantee in the form and substance that it was effectively issued under, and what other conditions were stipulated for the claim to be compliant. Once it's then compliant, we will then typically go back to that beneficiary and advise them that the claim is compliant, and effectively advise them in terms of under URDG, we have got 5 days to pay under that specific guarantee. As I said, by law and also under URDG, we do not necessarily have to tell the issuer of that guarantee that we will honor that guarantee, but as a bank and because of a relationship and as a courtesy call, we will then place a call with the effective issuer of that guarantee and advise them that there has been a compliance claim that has been lodged under a specific guarantee that we've issued on your behalf, and we will effectively, we have reviewed the guarantee, it is compliant, and we will then pay under that particular guarantee within 5 business days. Now, commercially, what then happens is that once the issuer of the guarantee, our client, is notified of such claim, we advise that issuer of the guarantee to engage with the beneficiary in order to see if there is any possible way for that guarantee claim to be revoked by the beneficiary. We are not effectively saying that it can be revoked, but we are saying go and negotiate with the beneficiary to ask them to potentially remove it if there is a way of actually revoking that claim. Obviously, no one wants a claim under a guarantee. However, it does not take away from our obligation created under that guarantee to pay within the 5 business days.
There's another question from Mapotla team. I understand SBSA is not party to the commercial agreement, but will you want to have a side of the commercial agreement to confirm the terms of the payout, or will this be included in the escrow agreement rather?
So as BK alluded to this point earlier, our escrow solution or escrow agreement is very much independent of the commercial arrangement, right? So we put the onus on you and the relevant supplier or the relevant counterparty to agree on the terms and conditions of the underlying commercial arrangement. Remember, we're not party to the commercial arrangement. We can have sight of it, but we're not going to dictate to you what the release and the return conditions are. So the onus is actually on you to agree with the supplier on what those release and returns conditions are. In most cases, they're not. They will mirror what is currently sitting in a commercial arrangement, because you've said, Lunga, if you do want to, like, for an example, let's say there's a sale of property. One of the conditions for payment under the sale of property is that it is now registered with the deeds office. So it would be a condition in your commercial arrangement. Then it's likely to be a condition for the release again under your joint instruction. But we as Standard Bank are not prescriptive in terms of what the return and the release conditions are. We leave it on you. And I also just wanted to touch on the question around the validation of the guarantee. So if all of our guarantees are issued in our Standard Bank letterhead, so you would note that it is a Standard Bank guarantee because you're going to see our letterhead. But in the instance that you are a beneficiary under the guarantee and you want to confirm that that guarantee is still in existence, it hasn't expired, it hasn't been cancelled, etc., you can send that copy of a scanned document to me. I can then have our team confirm in terms of whether this is a live or an active guarantee on our system. We also have Trade Online now being our digital and online platform that enable you to verify a Trade Online issued guarantee on Trade Online, send the link to the supplier. The supplier doesn't have to log in or have an account with Standard Bank. They can just go in on the link, on the Trade Online link, put the specific reference number of the guarantee on the link, and then it would verify whether or not it's a Standard Bank issued, it is still active or not. So we do provide you with those options.
Great. Thanks, Lunga. I think Funi's question is very similar to Mapotla's one, but let's give it a step as well. I mean, as she says, it appears that the escrow is more of a benefit of the supplier. But what happens if the SOE needs some sort of a comfort that the supplier, upon award, will be able to deliver on the project, i.e. their financial muscle to deliver? I think you can answer this longer, but I think this is the point we're trying to make earlier on, that we don't get involved on the supplier and the SOE's arrangement. But please, if you can attempt this, to just clarify that again.
Yeah, maybe let me attempt this particular one. So I think the benefit is for both the supplier and also the SOE. And then directly on the question around, doing an assessment on the ability for that particular supplier to deliver on the award. To Lunga's point and Asia's point, we wouldn't typically go and do an assessment on the supplier and the ability to deliver on that particular project as a bank. We would effectively rely on you, that you've done your due diligence, you've gone through your processes, procurement, etc., and you effectively are comfortable with that particular supplier to deliver on that particular project. Now, what the escrow does, however, give you comfort on is that we at least act as a second measure of effectively risk management, whereby once you've awarded that supplier the contract, then this is a way to provide yourselves comfort that you only release funds upon them actually performing, because ultimately you wouldn't sign that joint instruction without having verified that that supplier has performed under the underlying contract and you are comfortable to release the funds over to that particular supplier.
Thanks, Busa. Mfuni, I hope that answers you. That in a nutshell, I mean, you still have to still run your own supply chain processes around your supplier, whoever you're awarding to. The bank wouldn't step in that space, but we will be a second measure to risk management, where now we only release the funds once a joint instruction has been given by you and the supplier that you are comfortable that they've delivered, and now they can be paid. And that's when we pay. And I think I wanted to reiterate Benjamin to Nokulunga's point, sitting on the overall transactional banking side, the rates I've seen on this escrow are way even higher than what they give on a normal current account. So definitely there's credit interest, but because those funds are ring-fenced in the escrow and you don't have access to use them for normal day-to-day transactional, they then able to maximize the credit interest that they give on those funds. So certainly they do get credit interest at a higher level. I don't see any other hand or any other question on for this one. Dumisani, apparently you now can unmute yourself.
Yes,
Yes.
finally, thank God. We thank God. Eh? Yeah, when you read the Bible, there was a gentleman, John, before he was born. His father was muted for some time. Yes, but let's not dwell in that. Thank you so much, colleagues. I do apologize for attending the meeting very late. So my role at Joburg Market, we deal mostly with guarantee debtors. I took over this portfolio from a colleague of mine who resigned. However, when I came into the space, one thing that didn't give me comfort was the issue of validating these what you call a guarantee debtors. Because you might find that we've got a situation whereby we've got a guarantee data, the letter itself. However, you will find out maybe one of the guys has passed away, or something has happened, or maybe the company is being bankrupt, or something of that nature, right? So you find that on the guarantee itself, the letter itself, it's got contact details of, let's say, the business manager or the consultant that had assisted the tenant itself. However, when you try and engage the same person, I don't know, like it's a mission. It's really a mission. I even went to an extent to find out if doesn't Standard Bank have maybe a central place where it deals specifically with guaranteed data so that I can validate the data that I have? Because with us, it poses a huge risk because we've got people who are coming to buy at the job market on a daily basis. And if we've got a guarantee that we can't validate if it's still valid, if the person is still alive, if the best, it poses a huge risk. As we speak now, I'm sitting with a claim that I've submitted all the what you call the original letter for almost 5 months. I've been following up, no payment, and now we're approaching our year end, and I don't even know who or where to escalate the matter to, And when Auditor General comes, it's a finding, So I think that's one thing that's not giving me comfort because with guarantees, it's a huge risk to any entity. So I'm not sure how you guys can best help us because my assumption was that maybe there's a new system that you are bringing in place that addresses validation, that addresses communication in terms of the guarantees itself. So yeah.
Dumisani, I just have a question with regards to those guarantees. Are they like a Standard Bank issued guarantee or are they like a corporate guarantee that is signed by the relevant entity? I just need clarity around that.
All right, thank you for your question. They are a Standard Bank signed guarantee letters.
Okay.
Okay. So if I can just add a background, what would happen is that Joburg Market had a credit facility whereby we would say, I would give you a credit facility where you can go and buy goods there, by maybe your vegetables, right? and then we set a credit limit. Let's say if your guarantee is 50,000, you would have a credit limit of 50,000. So once you've exceeded the limit, the system, it will warn you that you have exceeded your limit and you can't buy anymore up until you pay whatever that you need to pay. So it's basically a 7-day payment term account. So it poses a huge risk.
Dimsani, may I just please ask that you share with me, say one example, especially the example that you're talking about around you having demanded over 5 months ago and you haven't been paid, so that I can just investigate it from our side, because we do have a team, our operations team, they do have data around all of the instruments that we've issued, active and inactive, so we can then be able to confirm that for you. And then just in terms of the demand, when you were making the demand, did you submit the original together with the demand letter in compliance with the actual provisions of the guarantee? But I guess we can have that offline just to unpack it further so that I can assist you in the most effective way possible.
All right, thank you so much for that. What I'd done was that I submitted the original guarantee together with a letter which states the amount that is due on our company's letterhead.
Okay.
My CFO had signed off for that, and we even attached the confirmation, a bank confirmation from our side, and also the reference that needs to be put when the payment is done.
No, happy.
However, yes.
Yeah, please just share that with me. I will share my email address after this call.
All right, perfect. Thank you so much.
Great, thanks. We do have one question from Funi. She's trying to unmute, but Funi, I see IT says just raise your hand and then you'll be able to unmute. Let's try that before I read your question. Okay, so are you able to unmute now?
Yes, I'm able
Perfect.
to. Thank you. Good afternoon, colleagues from Standard Bank, as well as the colleagues from the SOE. I think I just wanted to raise that it appears, unless I understood wrong, it appeared to me as though we are creating the escrow account because the supplier is more uncomfortable about the SOE's ability to pay than the other way around, because sometimes we award in our commercial arrangements to suppliers big contracts. I'm going to use an example. Maybe they must build a substation, and that substation is critical to my path as an SOE. So when I've awarded them, I want them to also demonstrate that they have the capacity to deliver. So typically, we ask them to give us letters of guarantees that we then verify. And I think there's the Joburg market guys speaking to the arrangements we would enter into with people that we are transacting with. So I was just checking, can I, as an SOE, as opposed to a letter of guarantee, enter into this tripartite arrangement wherein it's not me now who's depositing the funds, but it is the supplier who will keep the funds in an escrow to give me comfort that I will get delivery. And then at the end, if they do not breach, these funds go back to them with interest. I don't have an expectation, but just to manage my risk in terms of whether the supplier will deliver. But I can see the inverse is okay, and the benefits is that I free up my cash from my transaction account. I bank it with a higher ranking account because I would transact in any case. But the difference now is that I am placing it in an account that is bearing a higher than call interest rate. It would seem that's the main benefit, giving comfort to the supplier, and I also earn interest. But I was just checking the other way around when I feel I'm at risk as an SOE. Thank you.
Funi, thanks for the question. It's really one that I think requires more market practice insight before I go. So in terms of the escrow itself, and I think we kind of articulated this, the escrow account can also be used to complement your risk measures, right? It's never really a full-on substitute for some of the instruments. So under that scenario that you painted with the supplier, where they effectively give you a performance guarantee. Now, the thing about the performance guarantee is that once you receive a performance guarantee issued by a particular bank, that bank would have done the credit analysis of that particular supplier. They would then have been able to kind of understand in terms of the financial standing, and therefore been in a position to issue that performance guarantee to you, to your benefit. So you do get that added benefit from a beneficiary perspective, because you can take comfort that there is effectively a bank that has been able to issue this performance guarantee. And then in any case of a particular default under the performance, you can then claim against that guarantee. So that's the one piece. The second piece is that under the actual escrow, in terms of your suggestion to say, can you potentially get the supplier to place funds under an escrow, and then effectively the escrow earns interest, and then we can pay out interest. From a practical execution point of view, Standard Bank can facilitate that escrow account. But now, yet again, from an industry perspective, you have to then consider in terms of the supplier typically would need that liquidity from their end in order to perform under the contract. So they then need that working capital liquidity, those cash to actually procure, to build, to pay their employees, etc., to actually then perform under the contract. So practically, from a market sense, it will be very difficult to go and convince a supplier to go and place funds for the purposes of that particular project. I'm saying it from a practical industry perspective, not taking away that we can actually facilitate that escrow if that supplier is willing to effectively place funds under the escrow account.
Funi, are you comfortable with that answer? Okay.
I'm covered. I've picked up that I guess government is high risk for suppliers than the other way around.
It's not just government. As I said, we've actually had escrow arrangements for normal corporate clients. It cuts across all of our client base. It's just a mechanism that provides your supplier or your counterparty with comfort that you'll be able to pay them. It's literally different from your letter of credit or from your guarantee, because here you're just using your money and you're placing your money, which accrues credit interest. But it's not a unique public sector requirement.
Yeah, and also the performance risk as well on your end.
Yeah. And look, Mfuni, I think as I started in my opening, when I said the reason why we thought it was critical to bring it to government specifically, because we haven't done a lot of escrows in government. We've done it in the structures Nokulunga spoke about earlier on, sale of properties, etc., right? But we're starting to see a lot of that requirement coming in now. And we can't escape the realities of we're dealing with entities that have to go through really stringent processes to get an approval for you in order to add anything into your balance sheet. As Musa said, guarantees, LCs are seen as provisional liabilities. So they actually count as debt in your book. It then means you have to get those, when somebody's asking for those guarantees, you have to get those levels of approvals. So all we're saying is that instead of having to go through all of that for a project when I have to pay for anyway in the first place, here's another way of saying, instead of me giving you some sort of a guarantee, I'll have the funds for this project, but we're going to keep them in the ring fence account. You're only going to get paid as and when you deliver to the project. It takes away them requiring some sort of a payment guarantee from you guys, because that adds into your balance sheet. Mapotla, I saw your hand is up.
Thank you, Asha. So based on what you just said now, so while there's no payout, the funds are still in escrow. It is our asset, so we can disclose it as an asset on our balance sheet, right?
Yeah. Yes.
Okay, thank you.
That is 100% correct. I think that's why both BK and Oklunga kept on reiterating that the funds do not belong to Standard Bank. They're not Standard Bank funds. Okay, I note we only have 5 minutes left, and I'm hoping that we have been able to cover all your questions. But as I said, please do email me. We do Nokulunga is our resource from trade and supply chain who looks after the public sector. So certainly we will be having also bilateral conversations around. I think there's a need for guarantees conversation. We can hear from Joburg Market that definitely Dumisani will set up time with Nokulunga to take you through our guarantee structure, how it works. Mapotla will set up time to go through this again with Eskom in terms of the Escrow Solution as well as I think Benjamin is DBSA. So we definitely will be setting up one-on-one conversations to just dive out, go into deeper details around these solutions. As I said earlier, this was just to high level, share the knowledge, the experience that we've seen in the market and just the solution in a high level. But we will be meeting you on a one-on-one to go through it. Let me just hand over to Musa now to close it for us if there are no further questions or comments. And yeah, we can go on with the rest of our Friday afternoon.
No, thanks, Asya. And I'd really like to re-echo the thanks from, the Standard Bank team for everyone in the call, especially our clients, in attending the session and also taking the time from your busy schedules. We know that you've got very demanding jobs as well. And we really hope that the session has been very valuable and insightful and has provided you with some kind of gems of knowledge in terms of how you can apply the escrow solution to your organizations in terms of potentially mitigating performance risk or payment risk, and also ensuring that, we can partner with you as you effectively look at new projects, dealing with new suppliers, in addition to obviously your traditional solutions that we offer in trade, such as your bank guarantees and your letters of credit. And as Asya has mentioned, we are more than happy to engage. We will share the collateral, and Lunga, myself, and the team are ready to engage with you. And to close off, we are open for business, and we're really, really hoping to partner with you going forward. Thank you, everyone.
Thanks, everyone. Have yourselves a good afternoon. Bye.
Thanks, everyone.
Cheers, everyone.
Cheers, bye.
Cheers, everyone.